So, good afternoon to all. We are going to begin the chapter accounting ratios. Okay, accounting ratios. Write the heading accounting ratios. Now, tell me what is a ratio? Yes, what is a ratio? What is a ratio? The ratio, the same ratio what you have learned in your maths. What is ratio? How does ratio help you? Yes, anyone?
Simplify numerical value.
It will simplify, okay. And the main thing is it shows the relationship between two or more items. Yes, the relationship. Okay. So ratios give us the meaning of or the relationships that exist between various items. So these accounting ratios, they are a very important tool. Okay. It is a tool for analyzing the financial statements. What are the financial statements? Which are the financial statements? Financial statements prepared. Which are they? Final accounts of a business. What are they? At the end of the accounting period.
Trading account,
Ah, trading and profit and loss account
profit and
and
loss.
balance sheet. They are the final accounts or financial statements prepared at the end of the accounting period. And for what purpose is this prepared? Why do you prepare a trading and profit and loss account? Yes. Why is it prepared? See, trading and profit and loss account from the name. Tell me, when you prepare a P&L account, what will you understand about the firm or the business? Trading and profit and loss account tells you the profits, whether the business is making profit or the business is running in loss. Trading account gives you the gross profit. Profit and loss account gives you the net profit. Gross profit means the operating profit by dealing with the goods, by selling the goods. How much is the profit? When indirect expenses are also included, indirect expense and incomes are also included, then you get the net profit. So to understand the profitability, we prepare trading and profit and loss account. Then what about the balance sheet? Why do you prepare a balance sheet? For what? Yes. Balance sheet help us to understand the financial position of the business. How much is the assets? How much is the liability? What is the financial strength? Okay, whether the business is financially sound, strong enough. That is what balance sheet will tell us. So these are the financial statements of a business. Okay, now coming back to accounting ratios. These ratios, the same thing that we have learned in mathematics, the ratio concept, okay, that we are going to use to understand or to study about the profitability. Okay, we will compare various items appearing in the profit and loss account or in the balance sheet. We will find out how much is the gross profit and sales. What is the ratio between gross profit and sales? Or likewise, what are the ratio between current asset and current liability? We are going to compare, okay, or we are going to find out the relationship between various items appearing in the financial statements of a company, and thereby we are going to analyze what the financial position of the business, the profitability of the business. The same thing you are going to do in your project also. Okay, you will take a balance sheet as I told you. Okay, and these balance sheet, we will learn various ratios. You are going to calculate various ratios from your balance sheet, whichever balance sheet you have chosen for. That is your project. And finally, you will analyze what is the profitability, what is happening to the profits, what is the condition of current asset, what is the present situation of the liability asset, all those. Okay, now let me share the screen. So, accounting ratios are an important tool of financial statement analysis. Told you, yes. Analysis of financial statements are done. You can say it like that also. Whenever the financial statements are analyzed, the main tool, or we do it with the help of accounting ratio. Now, what is the ratio? Ratio is a mathematical number calculated as a reference to relationship of two or more numbers. Okay, relationship of two or more numbers. And how do we express it? You can express it either in the form of fraction or as proportion, percentage, or also as number of times. These are the various ways you can express this what ratio. Fraction, you know. Proportion, 3 is to 2, 4 is to 5. Percentage, percentage form. Number of times, 4 times, 6 times, like that. Okay, so these are the various ways you can express it. That is about ratios, and you got an idea about accounting ratio. We are going to use ratios to analyze the performance of the business, the position of the business, the financial position, or the profitability of the business. Okay, all these are going to be analyzed. We are going to study about it, study the financial position. Now, what are the objectives of ratio analysis? Why do you do this? Why do you do this ratio analysis? What is the purpose? What is the objective? Financial information for comparison. I have already asked you to collect the balance sheet of 2 years, two accounting period. Either you can go for 2020, 21, 1920, or any 2 years. Recently, don't go beyond 2016. No need. We'll take this only. 2021, 1920. Okay, two accounting periods. So you arrive at ratios. So that will help you to analyze, to compare, to do the comparisons. Evaluate current operation. Current operation can be evaluated. See, previously the sales was 20%. Now the sales is only 15%. What is happening to the present sales? So that you can take decisions accordingly. Okay, current operations. Compare performance with past performance. Okay, comparison with past performance. Compare the performance against other firms or industry. You can compare with other firms. Comparison can be done. Intra-firm comparisons, firm to firm, one firm with another firm. Efficiency of operations can be studied. Efficiency of operations. Risk of operations. Okay. Now, to know the areas of business which need more attention, which area requires more attention, which are the areas which can be improved if special attention is given, special care is given, these particular areas they will improve. So which are they? To find out that, to provide a deeper analysis of, that is a main thing, profitability, liquidity, solvency, and efficiency levels in the business. That is a main objective. Okay, accounting ratios will help to provide a deeper analysis of profitability, liquidity, solvency, and efficiency of the business. Sharat, switch on the video. Everybody, switch on the video. Okay. Then to provide information, just a second. To provide information for making cross sectional analysis interfirm within the firm, section analysis, one section is compared with other section. Then to provide information derived from financial statement useful for making projections and estimations for future. You make estimates. Estimation means you guess many important matters relating to this. Okay. So these are the objectives, and the most important objective is this: to provide deeper analysis of profitability, liquidity, solvency, and efficiency. Okay, going to the types of ratios. Ratios, there are two ways of classification: traditional classification and functional classification. Okay, traditional classification and functional classification. Traditional classification means you classify the ratios as statement of profit and loss ratios, balance sheet ratios, and composite ratios. You find in the textbook the ratios, com- the types of ratios. Okay, there is two ways of ratios, two-way classification of ratio: traditional classification and functional classification. Traditional classification means, or it includes, statement of profit and loss ratios, balance sheet ratios, and composite ratio. I'll explain. Ratios means when items inside the P&L account is analyzed. Okay, gross profit to gross sales. So both are the items that comes inside the profit and loss account. So if you are finding out a ratio of two items which are included in P&L account itself, that is called statement of profit and loss ratios. Balance sheet ratios. So what is that? When you are finding ratio between two items appearing in the balance sheet, if suppose you're finding ratio between current asset and current liability, or asset to liability, so both current asset and current liability both comes inside the balance sheet, appears in the balance sheet. So that is called, when you find such ratios, that is called balance sheet ratio. And we have another one, third one, that is composite ratio. Composite ratio means both the items included. If suppose we are finding out a ratio between items, one item from the profit and loss account, one item from the balance sheet. Okay, that is called composite ratio. Okay, this is the traditional classification. Now, in this chapter, we are going to learn about the functional classification. Okay, based on the functional classification, we have four ratios: liquidity ratio, solvency ratios, activity ratios, and profitability ratios. Okay, liquidity ratio, solvency ratio, activity ratio, and profitability ratio. These are the four ratios we are going to study about in detail. How do we find that? Okay, we will discuss these four in detail. Moving to The first ratio, that is liquidity ratio. Liquidity. Before that, tell me the meaning of liquidity. What do you understand by liquidity? What are liquid assets?
Assets which can be easily converted into cash.
Assets which are, yes, liquid. Liquid means liquid assets which are easily converted into cash. Okay, assets which are easily converted into cash or cash equivalents. They are in cash equivalents. If you are in need of urgency, immediately you want money. From where will you take the money from? Is it possible to sell your house and get money easily? Is it possible? No. So, is it liquid asset? Is your house, your property a liquid asset?
No.
No, it is not easy. It will take time.